Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. May was a constructive month for investors as financial markets continued to recover from the volatility experienced earlier in the spring. Equity markets moved higher, supported by resilient economic data, strong corporate earnings, moderating inflation expectations, and growing optimism that the Federal Reserve may still be positioned to begin lowering interest rates later this year. While geopolitical risks remained elevated, markets largely looked through near-term uncertainty and focused on improving fundamentals. The S&P 500 gained approximately 5.5% in May, while the Nasdaq Composite advanced roughly 7%, continuing to benefit from strong momentum in technology, artificial intelligence, and semiconductor-related companies. Investor enthusiasm remained concentrated in firms demonstrating durable earnings growth, pricing power, and leadership in digital infrastructure and AI development. Importantly, market participation broadened during the month with sectors such as industrials, financials, and select healthcare companies also contributing positively to returns. Corporate earnings were a key driver of performance. First quarter earnings results generally exceeded expectations, particularly among large cap technology companies. Profit margins remained resilient despite elevated borrowing costs, while management commentary suggested that business spending, especially on automation, cloud computing, and AI infrastructure, continues to accelerate. This reinforced confidence that earnings growth may remain supportive for equities despite a slower economic backdrop. From an economic standpoint, incoming data painted a picture of continued moderation rather than deterioration. Inflation readings continued to gradually improve, helping reassure markets that price pressures may be moving in the right direction. At the same time, labor market conditions remained stable, consumer spending proved resilient, and recession fears continued to fade. This combination of moderating inflation and stable growth helped reinforce investor confidence in the possibility of a soft landing for the U.S. economy. In fixed income markets, performance was more mixed but improved relative to prior months. The Bloomberg U.S. Aggregate Bond Index posted a modest positive return of approximately 1%, as Treasury yields stabilized and investors regained confidence that the Federal Reserve may eventually begin easing monetary policy. High-quality bonds continued to offer attractive income opportunities, with yields remaining elevated compared to historical norms. Municipal bonds and investment-grade corporate credit also saw improved demand during the month. Geopolitically, investors continued monitoring tensions in the Middle East, trade relations between the United States and China, and ongoing concerns surrounding global supply chains and energy markets. While geopolitical uncertainty remains an important risk factor, markets appeared more comfortable assessing these developments as manageable rather than systemic threats. Oil prices remained relatively stable, helping reduce concerns of a renewed inflation spike. Looking ahead, we continue to see both opportunities and risks for the near term. Among the opportunities, high-quality fixed income remains compelling. Today's bond yields continue to provide attractive income potential while also offering diversification benefits should economic growth slow more meaningfully. Broadening market leadership is encouraging. While technology remains dominant, improving participation from other sectors supports a healthier and potentially more durable market advance. Select international and value-oriented opportunities may become increasingly attractive as global growth stabilizes and valuation gaps remain meaningful. However, several concerns warrant close attention. Federal Reserve uncertainty remains elevated. While inflation has improved, the path toward rate cuts is still highly data dependent. Any reacceleration in inflation could pressure both equity valuations and bond prices. Market valuations, particularly within segments of mega-cap technology, remain elevated and could lead to increased volatility if earnings expectations fail to keep pace. Geopolitical risk remains a wild card. Unexpected escalation in global conflicts or disruptions in energy markets could quickly alter investor sentiment. Our outlook remains constructive but disciplined. We continue to believe that investors should remain focused on long-term fundamentals rather than short-term headlines. While periods of volatility are inevitable, diversified portfolios built around quality investments, prudent risk management, and long-term planning continue to offer the best path toward achieving financial goals. As always, we remain committed to actively monitoring market developments and making thoughtful adjustments where appropriate. If you would like to discuss how current market conditions impact your portfolio or financial plan, we welcome the opportunity to connect. Stay calm, stay invested, and let us know if we can assist you further. Visit mraadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website